Hi everyone, this is Rob Roy and welcome to the LA Wave Options S&P 500 US market update. Well, we finished a hell of a week, as you know by now, breaking through a number of different potential support areas to find support at the 61.8% fib retracement level from the first part of the zigzag in the larger wave 5 of the big LA wave 5 pattern in the market itself. Friday was interesting, finding that support and rallying back. I think probably had more to do with position squaring and short covering going into the weekend, with the concern that maybe there would be some central bank intervention. A lot of people are looking for a coordinated central bank intervention, central banks around the world getting together and all coming up with some sort of financial monetary intervention, injection of liquidity to help calm the markets. And the numbers that came out of China economically have been absolutely horrendous. And in Macau, the numbers came out for February were down 85% from February of last year. So that shows you the effect that this virus is having economically. But big question obviously is, what do we expect this week? So let's take a look at the charts and see if we can get an idea. Well, here's a chart of the market, and you can see clearly what a brutal week it was. I don't think that's a shock to anybody. Everybody is aware of what happened. And if you look at it, we're going to actually move to a weekly chart here in a minute, because I can show you some comparisons to going back to 2008, because a lot of people were talking about how this was a record as far as the number of points lost in a single week. But that needs some qualification, which I'll share with you. But before we get there, I wanted to show you a couple other of the securities that we've looked at in the last several weeks. Here's the dollar, which I think, rather surprisingly, this is a good thing if you're wanting the market to bounce and rally back. The fact that the dollar has come significantly off the highs. It was getting to the point where it was too high. And then we also had the issue with interest rates, and we had talked about this as well, that lower interest rates was good until we got to the point where we got abnormally low, even for the low rates that we've been, which is reflecting economic weakness. So lower rates is okay monetarily for companies, etc., but not when you get to the point where it's so exaggerated that it's clearly forecasting economic weakness. We talked about that in the last recording as far as the potential for a recession with the kind of growth stoppage that we have seen recently. And then, of course, the VIX. We've talked about this descending triangle, talked about how even on the VIX, technical patterns matter, and this was just classic. We had this descending triangle here, and watch what happened right here on the lows, and we broke to the upside. We had talked about, could we go down? We had a little bit of room to the downside, but clearly the big breakout was higher. But look, we broke out, came down, look, tested that trend line, and then broke big to the upside. I mean, that's just classic breakout from triangles, where you have a breakout, you test it, and then you explode to the upside. And then here's where it gets interesting. Prior to Thursday and Friday, yeah, we had a big move in the VIX, but it didn't look to the point where we really could rally to where it was just so panic-driven that we could get to the point where we could put in some sort of a bounce low. And I really think that's all we're looking for right now. I mentioned this in the last recording as well, that when you see this kind of damage done, you're likely to have to go through a process of bottoming. It's not just going to be a V-shaped bottom right back to the top. We blew past that a long time ago. But here's that fib level, if I was mentioning, where we found just a little bit of support here. Also happens to coincide with those lows here that you can see from August and tested again in October. So that's where we came to find support down here right towards the 61.8% level, and then we closed on the high of the day. Interesting is the nature of how far oversold we are, and closing near the highs helped a little bit to close that gap, but we're still very much oversold. I mentioned to you that I wanted to show you a comparison because I think it's warranted at this point in time. Here's a weekly chart, and then you can see that huge bar to the downside, and we lost 37 points on the SPY in a week. So that's pretty significant. And then when you look at it from a weekly standpoint, you still clearly see how oversold we are. But let's go back and look. Now, so remember this, we lost 37 points. And we go back to 2008 and 9. Here's the drop in 2008, where 1 week we lost 10 points. 8%. The next week we lost 20%. So we lost 8% followed by 20%, so roughly 28% within a 2-week time frame. And look, you can see that the 10-day moving average didn't separate nearly as much as where we are now. So again, if you're looking for a bounce, that's a positive that we went through is sideways consolidation. Here's the bottoming process that I was talking about, and I kind of think we're going to see something similar to this. It just doesn't feel like the absolute low is in. It feels like we're going to go all the way down and erase that entire wave 5 pattern, which I'll go back and show you in a minute. But here's the two things else that I wanted to add in here. We lost the 8% and the 20%, so that's 28% in 2 weeks. And if we go back and look at this week, even though it was 37 points, is only 11%. So we could have some more pain inflicted if we follow through with what happened back in 2008. But the other side of the coin is that we are more oversold. That's why I wanted to show you where we were with the 10-day moving average, the lime green line back there in 2008. But let's bring this chart back up, and here's the point that I was talking about as far as now we pivoted off that low, and maybe we get our bounce now. It certainly would be well timed, but it certainly feels like we've got to come down and test that low at some point in time. I hope we don't. If you're long the market, and hope that we bounce back and find some place of support up above here to do our basing. But it just would surprise me to come this close and not make it all the way down there. But that is a bit of support there, and it's a 61.8% fib level, so there's a chance that occurs. We took our remaining puts off for our subscribers on Friday, so we are looking for a bounce this week. It doesn't have to be the beginning of the week. We've got plenty of time, but we are to the point where we're looking for a bounce, and we already got some of it in the last hour that occurred on Friday, but a little bit more follow-through would be a very outstanding performance for what occurred last week. So that's a little bit of a commentary added in with some of the technicals, and we'll see if we get that central bank intervention. It wouldn't have been shocking to see them do something over the weekend. Maybe the Federal Reserve is going to wait till their March meeting, but there's a lot of people thinking that we can't wait that long. Right now, the futures, if you're wondering, had opened down to the big side, big time to the downside. They had opened over 50 points lower. They rallied back, and we consolidated for quite a while just to the positive side. Now they're back up 30 points. It looks like they're trying to make another run to the upside. But long time between now and when the market opens, so anything can happen between now and then. But certainly interesting that we had opened down so big. Here's another thing that I wanted to bring out. It's important to remember that the market looks ahead. The market always looks ahead, 6 to 9 months away. So the market will have bottomed and begun the process of basing and rebuilding long before the peak of this coronavirus, whenever that happens to be. But the market isn't going to bottom at the same time that the virus peaks with the number of people that are sick or whatever. Again, the market looks ahead. So some of what's going on now, I think, has to do with the virus. Then we have the elections on the horizon, which was expected to create some volatility. We'll see how Super Tuesday goes. If Sanders still comes out with such a commanding lead, that could change things a little bit. But as I mentioned in the previous recordings, it does seem that the market is moving, at least at this point, more in lockstep with the news that comes out on the virus. But Tuesday will be a good test to see if any part of this is political. So that gives you a brief update to what to expect at the beginning of the week, and I'll be back to talk to you again soon. Take care, everybody.